Hello everybody, my name is Alish Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This is my thoughts on market happenings for the week ending May 27th, 2022. Looking at the indexes for the week, the stock indexes TSX, Russell 2000, S&P 500, NASDAQ, and the Dow Jones were all up after a generally positive week. Oil was up once again for the week. Gold was the only negative. This is the first positive week in the last 8 weeks for the markets, breaking a 7-week losing streak. Uh, just some comments. Market selling until now has been orderly, making me think there's no panic and perhaps no capitulation in the market yet. Uh, there are recession worries in the market, first initiated by the inversion of the yield curve in Canada and the US, but for a brief time. The fact is that reliable recession signals also require a rise in unemployment and a tangible weakening of many advanced economic indicators such as housing starts, new equipment orders, international trade levels, retail inventories, etc. Apart from a transitory inversion of the yield curve, none of the above seem to be holding. And with the high employment, a recession happening soon seems unlikely. The US real estate sales have been slowing, partly because of mortgage rates having crossed the 5% threshold this spring. Sales of newly constructed homes fell a steep 16.6% in April compared to March, according to data released on Tuesday by the US Census Bureau. Compared to a year ago, new home sales in the US are down almost 27%. The S&P 500 did dip into bear market territory last week, down 20% from the peak in intraday trading last Friday. The market is pricing in several more rate hikes, and this is hurting technology stocks, especially because of the delayed future cash flows. The interest rates may get raised too much, and the central banks will have to cut them again if the economy enters a recession, or the Fed will stop close to where they are now if the data shows inflation numbers are coming back down. Alternately, the interest rate is now as high as the consumer can take, and demand will begin to fall, lowering inflation. The inflation may have peaked, but it is likely to remain elevated. Peak inflation will likely indicate a market bottom. So if we have hit peak inflation and now it is lowering, then that means we in fact did hit a market bottom. As rough as bear markets are, the good news is the future returns really improve once stocks are down 20%. In fact, a medium gain of nearly 24% a year after a bear market starts may help some beaten down bulls stay the course. On average, it took 19 months for stocks to recover their losses in the US from a bear market or a near bear market. Uh, but the last 3 bears or near bear markets of 2011, 2018, and 2020, it took stocks just 4 or 5 months to make up the losses. I'm guessing this is because people expect the losses to recover quickly, and therefore they do. The worse a bear market is, the longer it takes to recover, which makes sense. So, for example, when a bear market decline was less than 22%, it took just 7 months on average to recover. But when a bear market decline was more than 22%, it took an average of 27 months. Canadian businesses have the highest rate of insolvencies in the last 31 years during the first 3 months of 2022. So that's not great news. Turning to the US consumer, which is important because the US consumer is 70% of the US economy. But the consumer is healthy and spending, but their spending power is being eroded by inflation. Retail and consumer discretionary stocks may not be the best investment as consumers start spending less. In Canada, a Nanos consumer survey is showing an expectation of decrease in housing prices. Gasoline in demand in the US is back to pre-COVID levels, and it looks like it will take much higher gas prices than we have now on both sides of the border for consumers to get out of their cars. The US Fed released their meeting minutes this past week. They announced details of quantitative tightening plan, i.e. reversing the quantitative easing plan that they've been doing for years. And that's due to begin on June 1st, this coming week. This was all within the context of what the Fed described as, quote, a very strong economy, extremely tight labor market, and very high inflation. On Friday, the core PCE price index, a key US inflation gauge, is up 4.9% over past year, but this was in line with expectations. The Canadian banks reported this past week with generally positive results, but some bank-specific mortgage slowdown and cost increases have been showing up. Bank of Nova Scotia crushed Q2 profit estimates. BMO barely met estimates on Wednesday, and both banks are hiking dividends. They are expecting mortgage origination to remain strong, and the banks as a group are 10% up in loan growth for the first time since 2016. On Thursday, profits were up at Royal Bank, flat at TD, and they actually fell a little bit at CIBC. There is little fear of mortgage default with the employment rate being so high, and the bank profits increased 5% as a group, because of the higher interest rates being good for banks in general, but of course the possibility of a recession is not. The Royal Bank CEO said they see the risk of a recession at 50-50, caused by slowing real estate market and consumer and business loan slowdown due to higher interest rates. A slowing real estate market will be harmful to the Canadian economy, because a lot of our economy is related to real estate. The Bank of Canada is looking to raise interest rates to 2.5%, and since we are currently at 1%, that means we're looking at a couple more 0.5% increases definitely this year. The Davos Economic Conference in Switzerland happened this past week, with big company CEOs talking to the media. Looking at bonds, which up until now haven't really been investable, they're starting to look pretty good. With the higher interest rates, the yields are higher on new bonds, and companies are easily able to service the debt payments on old low-interest bonds, so the risk of default is negligible. Yields have become positive on German bonds for the first time in years. A little bit of interest about SPACs. The blank check post-SPAC index is down 60%, meaning the only people who made money off of SPACs were the people who put them together. Looking at China, they are in a different part of the business cycle, and they've actually lowered interest rates to improve their economy. The lockdowns aren't helping. There has been tension between the US and China over Taiwan, when Biden said the US would interfere militarily if the Chinese invaded, and economic sanctions would surely be implemented as well, hurting China further. China's growth may slow so that their GDP could end up lower than the US. The China lockdowns are also bringing down oil demand and snarling up supply chains. Looking at next week, on Tuesday, we have Salesforce.com and Hewlett-Packard reporting. On Wednesday, we have NEO. Thursday, it's Lululemon, Canadian Western Bank, and Friday is CrowdStrike. Looking at next week's economic events, Monday is the US Memorial Day holiday, so the US markets are closed. On Tuesday, Canada reports gross domestic product year over year and month over month results. On Wednesday is the big Bank of Canada interest rate decision with an expected 0.5% interest rate hike. And on Friday, we have US payrolls and unemployment rate. That concludes my thoughts for the week. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.